welcome to today's episode of Derek Invest. I'm your host, Derek Miller. What we're going to talk about in the second episode of the day is whether or not this correction in the S&P 500 and the NASDAQ is going to pick up steam and get a heck of a lot worse, or whether or not we should be at those price levels, those low price levels that we take off and we begin a new price run up, a new price rise. So the first thing I want to do is just real quickly, this is about education. Look, a lot of guys out there are going to tell you just enough to keep you completely reliant on them. Now, I have 25 years experience. I'm under I have no inclination into believing that I am going to teach you what I am able to do through these videos. But what I do want to do is give you enough information where you know the system works, you know that what I show you works, you know that you can trust it, and therefore perhaps it may work into your own trading system or may help you in some way. So based on the fact that I would like to educate you and I would just like to help you in whatever it is that you're doing, I want to show you how to identify major tops from major bottoms, also just your corrective tops from your corrective bottoms, and then how to identify when they're ending, right? Because those two things end in very different ways. In one of those scenarios, a major market top, it ends in capitulation, which is a huge price drive down that will bounce off the biggest volume you've ever seen in the world, right? Of course, I'm exaggerating, but no, it'll be massive, massive volume. It should be the biggest individual day's volume in that entire price drop in a major correction. In a much more minor correction, like a 10% correction, 5% correction, what it will actually be is a bounce off a bottom off a very low volume. And I'm going to explain to you why. So let's jump over and just start taking a look. So the first thing, real quickly, the first thing you have to realize when you're evaluating which index to look at. So right now, should we be looking at the S&P or should we be looking at the NASDAQ? Well, you always want to look at your leader. Your leader has the most institutional footprints that you can find based on trading activity, which is volume. It's going to have the best signals. It's going to have the most footprints, the biggest footprints. So it's really easy to identify. Your lagging index, the index being pulled along, which in this case is the S&P 500, will still have those institutional footprints, but they'll be a lot smaller. Now, back in 2008, that was a major market global event, and I'll show you how easy it was to identify. But your S&P was the leader because who was in trouble was the financials. Who was overvalued, who was over-optimistic, who was the geniuses were financials. Right now, that's all AI. They're the geniuses. They know everything. Technology is it's the greatest thing in the world, right? So right now, that's the over-optimistic. So when we go back, I'm going to show you the 2008, 2009 to show you what a major market top and a major market bottom looks at. But what we're going to look at there is the S&P because that was the leading index. What we're going to look at right now to figure out where are we in this current market, we're going to look at the NASDAQ. Why? Because it is the leading index. The leading index has the biggest footprints, everybody. All right, so let's jump over. I'm going to share my screen. Let's start to differentiate what a major market global economic event looks like versus your standard correction. And then even beyond, you can even take it many steps further beyond your standard correction down to where you can know, is this really just a 2% blip? Is this going to be a 5% blip? You can identify all of that as well. For today, let's just try to realize where we're at in our current market. And are we at a price level now where prices should be getting to move up? Or is this thing going to pick up steam and are we going to have a major market event here? After all, listen, the market fell nearly 10%. In fact, I think the NASDAQ did fall 10% from its highs. If not, it was very close. It was 9%, 9 point something percent from the highs of the NASDAQ. So we are definitely well into corrective territory. No one's talking about it because, let's face, look, why is nobody talking about it, everyone? Because they didn't know it was coming, and they don't, and by they I mean your typical kind of brokers, trend followers. Day traders typically are not good at knowing when the trend turns. That's where most of them get eaten up and lose most of their profits. I mean, your average day trader only makes 6 figures a year, guys. I'm not saying only is a respective word. Like everything is relative. Day trading is hard. It's busy. Well, actually, it's not hard. if you know what you're doing. It's actually quite easy. But if you haven't spent 20 years on the floor, or if you haven't spent 20 years like me having to learn how to do this stuff without all the information that those floor traders get, I don't get the information floor traders get. I had to learn how to do this stuff by reading the story of stock markets. That story is told via charts. And what you first have to realize is that every indicator that exists is just there to deceive you. Once you understand that, then you start to learn how to read it. And that's what I'm going to show you how to do now. I'm going on and on as I often do. Let's jump into it. All right. We are going to travel back in time here. And we're going to travel back to right here. Okay. Now I'm going to show you what things look like that are major market events. Okay. So this is the 99 bubble, right? Doesn't look insane here because this is the S&P 500. What happened as runoff, as we said, this was the lagging index in the 99 bubble. This was not the leading index. It's the lagging, the S&P. So prices fell. And as they hit bottom, people that bailed out of the NASDAQ needed somewhere to go. So they start jumping back into the S&P 500, okay? What we're looking at here is, let's get a date. The date here is December of 06. Now, I'm going to move really slowly. That volume, it looks really high, right? If you look at 2003, and then you say, wow, look at this volume. That is monstrous. Now, watch this as we approach the previous highs. I want you to watch this. So here we go. We're moving right along. Whoa, that was the big bar, everybody. This was the big bar right here. In fact, let's go ahead. That was the monster bar right there, okay? Look at that monster bar, everybody. Watch this. That's the monster. Watch. Now, the minute this happens, the minute the monster bar in a 10-year time frame is dwarfed and now looks like nothing, you know you are in for something. I'm not telling you you know what yet. What I'm telling you is you are in for something, all right? So let's quit highlighting and let's move along. Well, actually, let's not quit highlighting. We're going to highlight another area. So this is March of 07. Now, you can't say that you know what's going on there. Well, when you're approaching a previous high after 100% run, nearly 100% up in an index, and you get a volume bar like that, I assure you that I do know exactly what to do. And this means that institutional money is starting to scale out. Something was very well known in March of 07. Let's scoot real slow. Whoa! Look at that. Look at that. Look at that giant. It now dwarfs. This is the old monster bar right here. This is that high volume bar that I said you couldn't miss. Now look at this. Holy mother. If you don't know that this is a top that's going to reverse, shame on you. And I mean that. You don't know how to identify July of 07? Shame on, I don't know why you're in the business. Let's scoot over. Whoa. You thought July was big. You see August. That's the green bar right here. That's the green bar right there. Now, this is the top, folks. This is an indication of a global economic, we don't know what, but it is big, bad, and it has all the right people scared. The people that know what they're doing are terrified right there. I hope you can see that for yourself. And other people, they'll play nice with you. Oh, it's not your fault. You couldn't have known. If you didn't know, it is your fault. 100% your fault. Look at it. And it goes on. Price drops from 157.50. It doesn't matter. 157 down to 125. So you're looking at a 20% price drop in through January of 08 on the biggest volume. This is the S&P 500, folks. This isn't a penny stock. This isn't like Tesla going nuts in 2021. This isn't NVIDIA. Those are individual companies. This is the 500 biggest companies in the world. Look at the volume. And then preach. And then this is your capitulation. Look how little that volume is compared to capitulation. This is capitulation, everybody. That's when everybody quit. This is when everyone quit. Look at these. These were monsters. Look at the monster back here. Remember this, the initial monster. Look, what, ready? That's the initial monster. Look at that. Now watch this. That's what capitulation does. Right there. You'll get a lot of excuses, but I promise you this was easily identifiable. And that is what a global market, global market economic downturn, the beginning of it will look like. And it's all based on one thing, the footprint of the institutions. When the institutions get scared, you had better be scared. And if you're not scared, well, prepare to have your lunch eaten for you. And that's it. And then we move on. Now, if we move on to today, I'm going to switch us over. Actually, let me leave us on a month. That's a global economic event, everybody. Now, I'm going to show you something. Now, just as a reminder, remember what I told you about leaders and laggers? This was the leaders through the 90s. That's the 99 tech bubble. Does that look a little different than the S&P 500? What about the volume coming into 07 and 08? That look a little different? Yeah, they're not quite the dramatic scene of the S&P, is it? Not quite the same dramatic scene, is it? That's because the S&P is a leader in that one. But the S&P doesn't have the same dramatic events. Look at this. There's the S&P. That's March of 2000. Look, never even breached it. Let's go back to the NASDAQ. There's March of 2000. Look. Quite a bit different, isn't it? Now, we're not interested in the NASDAQ back then, although, is it possible that this is what people are driving with the AI fervor we have? It's possible. I don't see it yet, but it's possible. We're nowhere near those levels yet. I actually have a video that I did, a live stream I did a couple weeks back, comparing the PE of companies back then to the PEs of companies today, just looking at it from a fundamental basis. But let me tell you something. Fundamentals don't mean all that much. That's just something to appease the masses, really. Fundamentals don't play much of a role in the price of stocks and stock markets. Not really. Not in the short term or the long term. The value of the company is that's a whole different conversation. What you can know is supply and demand plays a role, right? Supply and demand of the stock itself, the optimism of the stock itself, what's the buyback program. It's all based on cash flow. I mean, that's what the price increase of anything is based on. If you go to an auction and the guy next to you has $100 and you have $10, the most that item's ever going to be auctioned for is $11, because once you hit 10, you're out of money. He still has 100. He only has to beat you by $1. But if I give you 50, now that same price can go to 51. Does that make sense? He has 100 and you have 50. He can outbid you at 51. There's nothing you can do about it. Same thing with the market. That's why you always have to make sure that you're following all three pillars of investing. That's investment risk, investment management, risk management, and cash flow management. And investment management and risk management are completely determined upon cash management. If you don't have a good cash management system, you'll get beaten. There's plenty of guys sitting next to you that have the 100, and you don't even have the 50. You probably have a quarter, and they can do it all day. So if you don't have proper cash management that's really tight, you'll get eaten up. Now, anyway, let's move on from that conversation. And so you've seen what a global economic event looks like via the S&P 500 in 2008. Now, let's go ahead and just roll into 2020 here real slowly. Okay. And there's 2020. So this is nothing to write home about, everybody. This was nothing scary at all. Price dipped. It had a high of 220, a low of 165, closed on 190, on, high volume compared to its preceding volume. Like, look, if you only look at the volume from, say, there, this top bar is the volume of 2020. It was pretty big. But all you got to do is scooch it over. I just don't want to give away where I'm headed with this. So that's high volume. It's the highest volume bar since 2011 and 2020. But 2020 wasn't scary. 2020 actually was a big indicator of how to behave during the pandemic, the quote unquote COVID pandemic. Let me tell you something. Global economics and the people that drive the global economies are terrified if there is anything out there that's going to wipe out any level of the human population or affect global economics and global economies. And that little baby volume bar was all you really needed to see. They weren't afraid of anything. And when they're not afraid, I'm not afraid. And if that offends you, tune out. I speak the truth here, and this is not a negotiable, argumentable conversation. We cannot argue about whether or not the global economy and the people that drive the global economy were scared. They were not, and that is a fact. They were afraid, however, back here in October of 2008. And let's just give you an indication. And by the way, this is the NASDAQ. If I pull up the S&P right now, it's far more terrifying than that is, believe you me. So let's just draw the line. So in case there's someone out there, that was real. Well, these guys say it wasn't. And that, my friend, is the difference in trading activity. From there to there. Pretty significant. So whether you like that or whether you don't, that says the guys that run the global economy had no fear. Now, I'm going to zoom in. Actually, let's leave it like this for now. So we're going to keep rolling over. So 220, biggest bar in nearly a decade. And here we go. Up, 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 up. Uh-oh. So this is 2020, right? What's happening now? Now we're starting to get bar after bar after bar after bar after bar, reaching that exact same level, aren't we? Now watch. Here we go into a new high price. Look at this. Look at how volume has picked up. Do you remember what happened in 2003 in the S&P 500? Do you remember what happened from 2003, 2007? All of a sudden, the volume was significantly bigger than any other place on the entire chart. It just started to swell up, look a lot like that. Okay, and here we sit today. Now, what I want to ask you is, when we saw that top that began, I believe it was March of 07, then July of 07, I said if you didn't see it, something was wrong with you. And then you got into August of 07, it was easily identifiable. So here we are. This is our backdrop, okay? This is our backdrop from 2020 until now. And this is us right now. This is us right now. Okay. So for anybody looking at that, what I want to know is, do we see a monstrous increase in volume right now at these high prices as compared to what is behind us? This is what's behind us. No, we don't, do we? What we see actually is a pretty significant drop-off in volume. All right, so we see a drop-off in volume. So what would that tell us? Well, first off, we know it's not a global economic event. We know that's not true. Clearly, that's not true, right? You just saw what one looked at. So, all right, it's not a global economic event. Fine. Well, what type of event is it? Well, it looks to me like at the high price, volume, which is this little green bar next to this red bar here, little green bar at the bottom in June of 03, looks like there wasn't much more call for where prices were. People just weren't interested in buying there. It's also summertime, so maybe it's summertime slowdown, right? And then you come into July and we have a reversal. Is it a hard reversal? I'd say that's medium. So let's zoom in a little bit and see what this is. This a top? Is this something that's going to turn into something meaningful? Because that's our next question. So here we are. Volume still looks light, doesn't it? It still looks light to everything in the backdrop. Let's zoom into a daily. Okay, so we have a couple of gaps that are always notable, aren't they? Why? Gaps are price targets, folks, especially on indexes. And we have one right there. Okay, that's up there at 490. Looks like we have one here. This one kind of filled, didn't. What are large price moves down on high volume? What are they indicative of? That's right. They're indicative of fear-inducing price moves, which means typically institutions are looking to accumulate more stock. Now, if you remember, when we looked at a global economic crisis at the top, there was all this major volume, but then when we came down, there was even more major volume. Like, do you remember what it looked like there in 09, that March of 09? It was like, it was a mountainous bar at the bottom because that's called capitulation. Now, when you have a simple correction, it kind of works the opposite. What will happen is your initial price move down. This initial one where the low is 455.63 will have the largest amount of volume. And then every time price comes down to that level, if volume continues to dry up, you're reaching the bottom of that correction. Why? Because if an institution is looking to pick up more shares, it's only looking to scare out so many people. Once it has scared out enough people where the like flagrantly weak hands are gone and it's picked up those shares, it'll begin the next run up. This is the ebb and flow of the market. There's nothing sinister about this. Now, what are we seeing right now? Are we seeing higher volume today or lower volume? Well, it's 11:42. So for those of you on the East Coast, 2:42, it's a little before 3 o'clock. Volume's at 36, almost 37 million. Average volume. Where's my average volume on here? Do I not even have it up anymore? No, average volume is right below it at 35 million. So we're exceeding average volume. Prices being yanked down. Definitely the goal here to scare the less knowledgeable and weaker hands. So let's zoom in a little bit. Here we are. So this is the initial price drop. So look at that price drop. This is your, I'm buying the dip guys. This is also, I'm buying the dip guys. These guys will all be bailing out here now if they haven't already. This 4-hour bar is falling off even more. Let's go down to 1-hour bars. We'll zoom in a little bit more. We can see that this is all by the dip guys. Here, people are probably getting a little more afraid. A gap up. Boy, this is beautiful. See, this is yesterday, and I love yesterdays because this really gets people excited. They go, it's over. Bing bong. I have news for you. If you are a student of mine or a student of the market and you have a gap off a low, I assure you that is not the low. That gap will fill nearly instantaneously, which it has. It's filling today. And sometimes you drive to lower prices and sometimes you don't. Right now, we'll see. It looks like it may drive to lower prices, which is absolutely fine. You should have good risk management, which means you know how to scale in and out of positions. So you've already, if you're a student of mine, you've already identified this, mainly because well, you may have done it for yourself, but I did cover this on Saturday of this week, telling you that, we should hit 454 on the QQQs and that this was nothing more than your standard correction. And so you may have figured that out for yourself. If you hadn't, maybe you watch my live stream or replay of my live stream and now you see it. So we look down here and we go, okay, so this may be the low. It may not be. What I can tell you is this. There are still an awful lot of people that got excited yesterday. You can typically suck them back out. That's what's being done here. So I would say there's probably a new low price to make. I'm going to tell you where I think it'll end. Okay. Good. Love it. Okay. So let's take a look where we think we are in this current market drop. So what do we want to do now? Well, I like to institute several different things when I look at price drops. One thing I do enjoy is Elliott wave to give me an idea of scale and time frame. And the reason I love Elliott wave is it's a basic concept. Your corrections are ugly, they're erratic, they're up and down, and they kind of move in 3 waves. Your trend wave is a 5-wave pattern, and that'll move 1, 2, 3, 4, 5. It's pretty smooth. Wave 1 and wave 5 are equivalent to each other. So the first move down, the last move down are kind of equivalent in time frame and in price move. And then wave 3 is your major wave move down. You'll have 2 major gaps there, and the biggest gap will be wave 3 of 3. And then your wave 5 has to exceed the low level of wave 3. To me, this looks like an Elliott wave pattern if I were to look at it. And I would say this is 1, 2. I would say this is wave 3. This is wave 1 of 3, 2 of 3, 3 of 3, 4, 5. This would be wave 5, 1. We should have a 2 and a 3. So this wave should probably finish. If we're looking for a target down, my guess would be how many percent? What percent did we move on 1? We went from like 504 to 491, 15 points. We went about 3%. We'd be looking for about a 3% move down here too. 47.50. So we're looking at nearly 15 points, maybe 13 points. We started at 50, so we have to breach this. You're probably looking at 450. You should probably be looking at 450 here. Looks like this should complete around 450. Eight 1 2024. Whoop. QQQ. Call it 450. Price target. How long did wave 1 take, everyone? Am I on a daily? No, I'm on a 4-hour. Let's see. 1, 2, 3. It took about 2 days. So we began this. So this should be over probably tomorrow. Let's give it one more day, though. It's the 1 second. So it's the second. So we'll give this the 5th. Should be over tomorrow, though. And then, what should we see at that point? Oh, let me put price target here. Every time I don't write price target, someone says, hey, Derek, why don't you write price target? I'm like, I forgot. Tarbit or target? All right. So, there we go. Beautiful. And for you futures traders out there, if you're not doing this stuff or you don't know how to do this stuff, you should be following me. In fact, if you're a futures trader, that means you know how to move fast. You're decent with levels. You probably use Fibonacci. You probably use moving averages, and you probably use ranges, and you support and resistance. Knowing this will make you 1,000 times what you are now. Just so you know that. Because when you blow out a range, or you blow out support, or you blow out resistance, when you do that, you'll know where to look back to. You won't just look for the next level of support and resistance. You won't just look back for the next range. So anyway, if you're doing futures trading, if you're doing options trading, and you're not following me, or you're not a student of mine, it's a big mistake. You should be. Okay, listen, once we bottom out at this price, we'll be watching that rise again. Just because this wasn't the real thing doesn't mean the real thing can't be coming. All right, everybody, thanks so much. Remember, every day above ground is a good day. If you're having a bad day, you haven't failed yet, don't forget it. How do I know that? You're still here. Get outside, smile, fake it till you make it. I already said my close.